Hello and welcome everyone. My name is Cameron May. I'm a senior manager of trading and derivatives in the coaching department here at Schwab. And today we're going to be talking about taking a step back and looking at things from a long-term perspective. Sometimes a trader or an investor just likes to get a gauge for where things appear to be going over the long-term horizon. Today I wanted to talk through 5 tools that might assist a trader or investor in gaining that perspective. I think this will be an interesting discussion. We haven't reviewed these tools in several months, going all the way back to 2025, so I thought it's about time. So this is going to be an interesting discussion, introduction to some of these tools for some of you, but for others, it may just be revisiting some familiar tools and getting a little bit deeper grasp on those. So before we can get into that discussion, let me first of all say hello to everybody. Welcome to Schwab Coaching. Great to see all the familiar names out there. Great to see a few new names, but hello there, Life in the Fast Lane, Teach to Fish too, JDLMI, Greg, Frank, Scott, Eva, Kevin. Who else is here? We have Rojo and Richard and Wiley and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, well, enjoy that recording. That's a great way to watch these webcasts. But be aware that you are invited to join us in the live stream audience. If you'd like to be here, this is a Wednesday webcast series. That's when we kick off the live stream, and it starts promptly at 2 Eastern time. Now, I also want to let my live stream audience members know that my very good friend Barb Armstrong is hanging out in the chats with us. She's already been keeping an eye on things, and any questions that come in that I can't get to, as long as they're not too far off track, Barb's going to be there to help pick up the slack for me. So thanks for having my back there, Barb. Barb and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. So you can find Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. And you can also follow me now on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this discussion of using charting tools to try to gain a longer term perspective of market conditions, maybe where we think the markets might be heading. As we do that, of course, we need to bear in mind the risks associated with trading and investing. This is important information, so keep these disclosures in mind. All corporate or issuer names and market data shown are for illustrative purposes only and are not a recommendation, offer to sell, or a solicitation of an offer to buy any security. Schwab does not recommend the use of technical analysis as a sole means of investment research. Any investment decision involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's get into this discussion. I'm going to go right to the Thinkorswim platform, and let's just put ourselves in the shoes of that investor or that trader who's trying to get a gauge of current conditions and maybe put it into perspective of where they think those conditions may carry stocks over that longer term horizon. All right, so our focus is not going to be on minute to minute, day to day, momentary changes in price behavior, but that longer term. So here we are looking at the S&P 500. And that longer term view can sometimes be distracted by this day to day, white to red, red to white activity. So for some traders and for some investors, what they'll do when they're gauging the longer term is they'll recruit technical tools to assist with that, to maybe eliminate some of the emotion that can be attendant to the jerky behaviors of day-to-day activity. And one of the most commonly used technical indicators, as a matter of fact, to be my argument, even though I don't have the data to support it entirely, one of the most commonly used indicators on a chart is a simple moving average. And that is an indicator that is sometimes used by a trader or investor to establish trends. Now, they also might use that as to identify potential price floors and price ceilings. But let's add a simple moving average to our chart. So I'm going to click on our little flask icon here. It gives us access to our hundreds of technical indicators, and I'm just going to type in simple, the word simple for simple moving average, or at least the first few letters. There's our simple moving average. Let's add that to our chart. And by default, Thinkorswim doesn't know what time frame we're intending to trade or invest. So the default is just going to go with a short-term time frame. Looking at just 9 days on this daily chart, 9 days worth of data to generate this indicator. I'm going to extend that out fairly dramatically. Let's look at this again through that long-term lens. So I'm going to come over to the gear icon, and we're going to change this to 200 days. The length of this indicator is now going to be 200 days worth of data. And I'm going to click OK and click Apply. And just to acquaint us now with this indicator that I've added to my chart, you can see we have this green line that's passing through the price chart. And if we follow it all the way over here to the right, we can see the current value of that line, which is at 66.1609 as of the moment of this recording. Well, what is this telling us? Well, a simple moving average simply looks at the prescribed time frame. So we've chosen 200 days here. So our simple moving average is going to look at the last 200 days. It's going to look at the closing values for the S&P 500 over those 200 days and give us an average. So the average closing value of the S&P 500 over the last 200 days, that's a fairly longer term perspective. That's about a year. The average value is at around 66.16. And we know that if we were to have calculated this value 6 months ago, it would have been different. If we were looking at the average trailing 200 days leading up to, let's say, September, well, prices of most stocks were lower at that time. So the average for the S&P was lower, and therefore our average value would have been down at a lower level. So that tells us that these levels change over time. It's a simple average because it just uses closing values over the selected time frame, but it also moves. So it's known as a simple moving average. And over time, that's going to draw for us a trend line. And so for some traders and investors trying to gain a longer term perspective, it's not the day-to-day movements of price or the indices that self-directed investor is following. Instead, it's the net change in the average value of those prices. And that's going to change much more slowly, but hopefully calm down that day-to-day activity and provide that longer-term perspective. So in this case, what we'll notice is that average has been pretty persistently just moving up and up and up and up. And for a technical trader or investor who uses this tool, that might lead them to conclude that we're still in bullish market conditions, at least through this one technical lens, despite the last few weeks of selling that we've seen. Overall, still looks bullish, at least through this lens. Now, that I'm going to call our first stock chart tool that might help us gain longer term perspective. But there are still those who would say, so Cameron, you telling me that yes, the long term seems to be up, we're supposed to entirely ignore what's been happening in pretty much all of 2026? Doesn't it seem like in the shorter term, maybe leaning more intermediate, there's been a softening of that trend? How long do we have to wait? Do we have to sit here maybe 100 days after the trend has changed before we can admit that it's changed and maybe start making adjustments to a portfolio or taking a different approach with our trading? Well, what some will do to address that question is they will actually use a shorter term indicator to potentially signal that something's afoot and maybe there is a long-term shift coming that we just haven't seen yet in this 200 period moving average. So what they'll do is use a combination of moving averages or trend lines. So we're going to add a second trend line, and it's the combination of these two that's going to be our cool tool or tool number 2 for charting tools for gaining a longer term perspective. Let's go up here to our edit studies. Pardon me. And I'm going to add a second simple moving average. Let's add this to our chart. And this time, I'm still not going to leave it just 9 days. That's a pretty active chart, trend line. Instead, I'm going to replace this one with 50 days worth of data. This one's going to be a little bit hotter in its movements, a little bit faster in its movements. So let's give it a warmer color. I'm going to change that to red. And for those that can't tell the difference, not everybody can see the difference between green and red. We're going to make this 50 period simple moving average a little bit thicker. Let's give that a width of 3 out of 5. We'll click OK and click Apply. Click OK again. So what we're left with now are 2 trend lines. one that's looking over the last 200 days, and one that's looking over the last 50 trading days. So this is basically one trading quarter's worth of price data. And this is going to be a little bit more sensitive to more recent changes in price. And you can kind of see this tilting downward at the moment. So does this mean our longer term perspective needs to change immediately? Not necessarily. Typically, that perspective changes if we get something like this, known as a crossover. So I know we have 89 people watching a live stream right now. Most of you, I think, if you've been watching my webcast series at all, and I think most of you have, will know the name that's commonly applied to a shorter term moving average that crosses up and through a longer term moving average. And specifically, I'm going to be very precise here, a 50-day crossing above a 200-day, or we could also use a 10-week crossing up above a 40-week, because basically 50 days are essentially 10 weeks. 200 days are essentially 40 weeks. So whether we're using weekly or using daily, as long as the time frame is relatively consistent, we may have the same title that we apply to this crossover event. This is known as a golden cross. Sounds pretty enticing. This is not a sales pitch for this signal. That's just the name that somebody else, I say that they had a flair for the dramatic. That's a name that somebody else who created this indicator titled it. But regardless of the name, golden cross, yeah, it's trying to describe a specific outlook, trying to call the trader or investor's attention to maybe a long-term shift toward bullishness. Yeah. Wiley says he's going to call it a platinum cross. Close enough, right, Wiley? In any case, what you'll notice is that this did not call the absolute bottom, and it never will. At least I've never seen it do that. Maybe someday that'll happen. I can't ever say never is always a strong term. So is always. But I can say that I have never seen it call an absolute bottom. It's not designed to do that. Instead, what it's intended to call attention to are shifts in price levels that have extended out for weeks, maybe stretching into months, and maybe pushing into that longer term territory now. So this is known as a golden cross. What do we call the opposite? We refer to this as a death cross. In this case, that sounds awfully spooky. This one was kind of premature. Might have sent, and just like in the case with just about any technical approach, nothing's perfect. And the signal of this death cross might have been, hey, things look like on the longer term, they might be bearish for a while. And it didn't turn out that way. Turned right around over the course of the next few months. We reversed back up, course corrected to a bullish outlook, and that's what sort of persisted till now. So for a trader or investor using this combination of tools, they may look at this recent dip in the 50-day moving average and say, all right, well, it's come down a little bit. Prices have come down a bit, but that 50 is still above the 200. There is no death cross apparent. And that might just give them additional perspective, maybe put this recent price activity into a different perspective. This may be a check for, let's say, continued bullishness. Now, it's not a guarantee that we're going to get continued bullishness, but that would be the typical interpretation here. So there are two tools. We can use individual moving averages or potentially a combination of those two. Now, the next tool that we're going to look at is actually an examination of the tug-of-war going on between speculators who are more aggressive and those investors who are possibly a little bit more defensive. And this is leaning into what we might call the economic cycle. And that is typically over the span of, on average, 6 to 10 years, the economy will move through cycles that can be mirrored to some extent by stock behaviors. But over long-term time frames, there are times when investors see economic scenarios as being possibly more favorable. We're in an expansionary phase of the economy, and investors might lean as a result more toward speculative positions in their portfolio, buying more, maybe small cap stocks, things like that. There are other times when maybe those investors and traders see things as not being so economically brilliant, and that may affect the way that they manage their portfolios. they may move more to a defensive positioning within those portfolios. So what some will do is they operate on this basic assumption. If comparatively larger amounts of money seem to be going into smaller capitalization stocks, it might imply that there's a stronger economic outlook. At the same time, if there's more money being directed to, let's say, larger capitalization companies, less volatile, maybe providing less potential, at least theoretically, for upside, but also maybe minimizing or reducing downside risk exposure, that might give some insight into where we are in the economic cycle as well. So we're looking at small caps versus large caps. So how might we do that? Let's first of all clean up our chart here. Not just looking at the trend lines on one index, but comparing two indices. Let me actually remove these drawings as well. There we go. And what we're going to do is compare the strength of the Russell, these are 2,000 smaller capitalization companies, against the strength of the S&P 500 and see who seems to be winning the tug of war. So here's how that might be done using a third tool on charting known as relative strength. So I'm going to come up here to our Edit Studies icon. I'm going to enter relative strength, or just the word relative will bring up relative strength. Now, we need to be precise here. Notice that I'm selecting relative strength and not the relative strength index. Sometimes you'll see relative strength index. The relative strength index basically compares the strength of a company versus its own history, or a chart against its own history. With just plain relative strength, we're comparing two different stocks or two different indices against one another. So let's select relative strength, and you'll notice by default the comparison is going to be the S&P 500. So we have RUT charted for the Russell, and we're going to be benchmarking that against the S&P 500. Let's click Apply and click OK, and here's what we're left with. We have this blue line. Now there's some dashed blue lines. This is kind of cheating because I drew those in before the webcast started. Just ignore the dashed lines for just a moment. And instead, we have this blue line, which is our relative strength index. Here's the interpretation of that blue line. What it's doing on an ongoing basis is it's comparing the performance of the Russell against the performance of the S&P 500. So if the Russell is going up and the S&P is going down, obviously the Russell is stronger, and you'll see this line rise. At the same time, though, if the Russell's going up, but the S&P is going up faster, actually, even while the Russell's going up, it's comparatively or relatively weaker than the S&P, and we'll see this line go down. Now, also, if the Russell's going down, the S&P is going up, the Russell's relatively weaker, we can see this line going down. So basically, anytime the Russell is relatively stronger than the S&P, we'll see the blue line net rising. And what that might mean to our longer-term investor is not on a day-to-day basis, but maybe on a long-term basis. Let's switch up our time frame here. I'm going to change this to a 4-year weekly chart for a very specific reason. All right. But for our longer-term investor, they may just look at the general trend of this relative strength line, and if it's in persistent decline, what that means is for the time frame of that chart, and this is a 4-year weekly chart, the relative or the Russell small capitalization companies have been underperforming the S&P or larger capitalization companies. What might that say about investor sentiment regarding, let's say, economic conditions? Maybe they're bullish, but still a little bit hesitant, a little bit defensive. At other times, though, when we see the Russell strengthening, and this for users of the relative strength indicator, when we have a downward trend line like this one that really started back here in April of, maybe even March of 2023, just downward sloping, just a comparatively weak Russell versus the S&P 500 until about August of 2025, we see that start to shift. And the Russell, since these lows, maybe a little bit after that, has been outperforming the S&P. there may be an actual strengthening, and I know this may not align with everybody's personal economic outlook, but at least comparing the small caps to large caps, small caps starting to gain a little bit of momentum. Now they've surrendered some of that over the last few weeks, but from a long-term perspective, that may be seen as inconsequential. All right. So this relative strength tool can potentially provide some powerful insights into investor behavior on a very large scale over very long term. And why did I choose the 4-year chart? Well, if a typical economic cycle stretches from 6 to 10 years, from peak to peak, or from trough to trough, half of that time frame, maybe the expansionary phase of the economic cycle, might last 3 to 5 years. The contraction phase of an economic cycle, maybe 2 to 4, 3 to 5 years. So we're looking at a 4-year chart as sort of half of a traditional economic cycle to see how are things appearing to develop over that long term. All right, so I'm going to park it right there. Interesting tool. We're going to keep that tool for our next discussion, next portion of our discussion. But I do want to call out that there is a survey in the chat window for our live attendees. This doesn't happen in every one of our webcasts, so when we get the opportunity, if you would just do us this favor, anytime you see a survey, click the link and then fill that survey out after the webcast is over. You can give us some honest feedback. What I can say about my webcasts is that if you take the time to fill out one of my surveys, I'm very deliberate. I will definitely take the time to read through your comments and to read through how you filled that survey out, because that data is definitely helpful to me. If you've never filled out one of our surveys, they're really short. There are 2 questions. Then there's a comments box and a suggestion box. But if you take the time to fill it out, it's never wasted effort. I'll take time to read it. All right, Barb, thanks for reposting. But let's again gain some of that longer term perspective. I know it's been a rough start to 2026, but somebody who's looking at things from maybe a little bit of a higher level, at least through the tools that we've been using, well, the 50 period simple moving average still on pace ahead of the 200. There's a little bit of a narrowing, but that might still be seen as a check for bullishness. Now, moving a little bit deeper, and also price is still holding above the 200 period moving average, just for those that use a single moving average as an indication of trend, plus that trend seemed to be climbing. Also, it may be seen by some as interesting that there seems to be possibly a net migration of cash from large cap, maybe more repositioned into small cap. There may be a larger appetite for risk than might be otherwise apparent on, let's say, a shorter term chart. So that's interesting. Now, let's move to the sector level. Sticking with that economic model, there are some sectors that investors, according to traditional models, some sectors that will tend to thrive in an expansionary phase of the economic cycle, and others that will tend to comparatively thrive during the contraction phase of an economic cycle. So where do we seem to be right now? Let's see who's been driving things recently. Now, by recently, I'm still going to stick with the 4-year view. So I'm not talking about recently as in the last 5 minutes. I'm not talking about recently as within the last month. But what's been primarily driving market behaviors over the last several years? And have there been any significant shifts just recently, at least among the different sectors? So I'm going to go over here. Let's first of all, actually, I won't even need to change our chart. Let's just leave that the way it is. But I'm going to come over here to our watch lists, and I've already preloaded the 11 sectors that comprise the S&P 500. Let's expand this out a little bit so you can see all 11 of those. If I drag the description over a little bit more, you'll be able to see those a little bit better. There we go. Now, if you don't have the S&P 500 sectors at home on your Thinkorswim, here's where we find those. Just go up here to the watch list heading, go to the public watch list published by Thinkorswim, and choose S&P 500 sector. Right there. It'll say sector indices. It's just the sectors. But in any case, another thing that I do is I'll add the description. That just tells me which sector it is. So that can be added right here using the little gear icon. Just customize the columns and choose description among the different column headings that can be added. So we just add that, click OK. So that leaves us with the 11 sectors. And what we could do, if we had a little bit more time, we might go through all 11, see which are going up and which are going down. But I just have a question for you. When investors feel good about current market conditions, they look at the economy and the economy appears to be strong, which sectors, according to traditional economic cycle models, are expected to do well? Now, expectations don't always align with reality, but during an expansionary phase of the economic traditional model cycle model, which sectors will tend to outperform? Well, among a few sectors, a couple of those are technology and communications. Let's see what's going on with technology on this longer term perspective. So I'm going to click on the information technology sector, and you'll notice, yup, stretching all the way back there to 2023 again, the sector has been showing some strength, and relative to the other component companies, or relative to the other components of the S&P 500, this has been a particularly strong sector. When we see our relative strength rising now, it means that the technology sector has been outperforming, let's say, the S&P itself. So that has been going on for years now. Could this be getting fairly late into the expansionary phase of an economic cycle? Possibly. I think it's still interesting that there does seem to be some rotation still underway from large cap to small cap comparatively. But what some investors might be looking for is if we break this trend line on more expansionary sectors like technology, that may be an early signal of a shifting in that economic model. Now, this is all going on assumptions that reality always aligns perfectly with the textbooks, and it doesn't always. But it still might help that longer-term investor or trader gain that long-term perspective. So let's go have a look at the communications sector, also traditionally an expansionary phase sector of the marketplace. And what has it been doing? Yup, it's been not just keeping pace with the S&P, but outpacing the S&P, going all the way back to 2023 again. And this actually, I think it goes back a little bit into 2022. So for now, this may be a check for markets look bullish as we look at the 50 period of 200, or the 50 period simple moving average rising above the 200. It may be a check for bullishness for the net flow of cash, apparently, from small cap or from large cap to small cap. And we're also seeing the continued strength of a couple of the more expansionary phase sectors of the markets. Let's look at more of those defensive sectors. Maybe we'll look at like staples and healthcare. When investors get a little bit less certain and they're trying to move their risk assets towards something that may be a little bit safer, I always have to put safer in parentheses or in air quotes, they may take some money out of things like technology and communications, reassign that to maybe healthcare or staples, the corners of the marketplace that deliver the sorts of products and services that we just have to have, no matter how the economy is performing. So let's look at consumer staples. How has it been doing over this longer term view? Look at this. It's actually been going up. Isn't that bullish? Yep. But not going up as well as the S&P sort of writ large. So yeah, that defensive sector still not quite showing strength. Recently picking up a little bit ahead of steam. If we were to see maybe a breaking of the trend line on technology and on communications, and maybe a breaking upward of the trend line on consumer staples or other defensive sectors, for some that might signify a shifting in the economic cycle. So if we move on now, let's look at one more. Let's look at healthcare. What's been going on with healthcare? Very similar. Again, a defensive sector that's just not quite yet breaking those longer term trend lines. Little bit of sign of strength over a relatively short period of time yet. Still may not yet be seen as technically significant by some. So there are 4 tools we've learned simple moving average, a simple moving average crossover system. We've looked at things through a comparison of the Russell and the S&P 500 using our relative strength tool, and we worked our way through the different sectors. So I want to look at the long term through a very different lens. I'm going to clean up my chart here. Let's go back to the S&P 500. Let's remove the relative strength right now, just comparing the S&P to the S&P, so it's just a flat line, not doing us much or providing much insight there. But I want to switch this back to a 1-year chart and remove that relative strength tool. Click apply and click OK. And I want to look at the S&P's behavior, not just over a long term, but over the long term on average. I know that almost sounds like the same thing. It's not. I'm going to use what's known as for our fifth tool, the seasonality tool on our chart. Because we've kind of gotten off to a rough start here in 2026. I don't think that that's a surprise to many people. S&P currently at lower levels than on the first trading day of the year. But I wonder, what has the S&P typically done from this point forward through the rest of the year? And there's a chart that can show us that, at least compared, looking at average behaviors of the S&P over the last 20 years, and that's called the seasonality chart. So I'm going to come up here where it says Style, and I'm going to change this from a standard chart to a seasonality chart. So let's load that up. And I think, again, 124 people watching, a lot of you are going to be familiar with this. A lot of you are going to think this is a great new discovery. How many of you, just to chat in a Y or an N, are familiar with a seasonality chart? So as you chat that in, let me get you acquainted with it. Right now, what we're seeing is 2 charts. We have a little green one right here that seems incomplete, and then we have a red one that looks a little bit more traditional, like a line chart. Well, the green chart is just showing us this year so far to date. So this is where we started the year, and this is now March 18th, present day. This one down below is last year. So very quickly we can see, okay, well, here's how we got started this year. Here's how we got started last year. It looks somewhat similar. Okay, Kevin, Doopy, let's see, who else? Scatterbrain, Teach to Fish too. Mark Woods says no. So those not familiar with this, great. I always like to introduce new tools. It's not a sales pitch for a new tool. Use it or don't, it's up to you. But Life in the Fast Lane, Journey, Richard say, yep, familiar with this one. So it's kind of nice that we can compare the year to date so far to what happened last year, but that's sort of a data set of exactly 2. It's not very much information for somebody trying to get a long-term perspective. So what might we do here? Well, I'm going to switch this to a 20-year. Now I'm going to choose 20-year 1 day. And what this does is it's now comparing this year to the average performance of the S&P 500 over the last 20 years, from day to day, from week to week, from month to month, all the way over the course of a traditional January to December year. But I will say that average is kind of squished down here at the bottom. So let me zoom in on that. We're going to actually sacrifice our view of this year. We already know what happened this year. And I'm going to come up here to the chart scale tool. See this little wiggly line with 2 horizontal lines? Click on that. And I'm going to change that to manual. It's going to allow me to manually manipulate the chart. And specifically, I'm going to go down here to the bottom, and I'm going to click just above that line and then drag down to just below that line. It's going to highlight that 20-year track record, and now it's going to zoom in on that. See that pop? So what we're now looking at is how the S&P has performed on average over the last 20 years. It's not just we brought up a 20-year chart. Nope. This is showing us, well, on average, what did we do in January? What did we do in February? What's happened in an average March? So let's go to March 18th. The average March 18th, that takes us to right here. What do you notice about the months over the last 20 years? What has typically happened in the months following that March 18th? I'm just using it as a convenient benchmark because it happens to be today. Yep. the next few months have typically been quite strong, about the strongest of the year. So let's just draw in a line going from today up to about, I don't know, maybe around July 20th. This is interesting. Wiley, sorry, is my little picture in the way? You might have to use your imagination for just a moment, but you can see my trend line extending up to July 20th. Yeah, this is traditionally, at least over, if we call traditionally, just what's happened over the last 20 years, this is a very bullish time of year. And if we've already used our other tools, we're starting to already get a picture of what the investor or the trader might have in mind. Might have been leaning toward bullishness. Well, this additional long-term perspective might add a little bit more to that argument. It's not a guarantee. Wiley, thank you. Yeah, we have a great production crew behind the scenes, and they're listening. And when they see something that can help out, they help out. So thank you. Anyway, what about from July 20th through most of the rest of the summer? We maybe hit the summer doldrums and we finally wake up as Halloween approaches. Yeah, those few months right there, July to October, not so strong. But after that, moving toward the holidays, how have we finished out a traditional year in the last 30 years? That's been, or last 20 years, been quite strong. So that's a nifty little tool, right? JDLMI says, I'm getting excited. Well, we'll see if 2026 holds to this pattern, but this has been the typical pattern on average for the last 20 years. So we'll see if the next, what is that? How many months is that? 1, 2, 3, 4, and change. Yeah, it's actually 4 months and 2 days. We'll see. But I think that's still potentially a powerful tool that can provide some quick insight when an investor or a trader is trying to gain that long-term perspective. We're just going to call that long-term tool number 5. And I hope that was an interesting new one for you. But guys, we've accomplished what I set out to do today. I wanted to talk us through 5 tools that are available on the Thinkorswim charts that might help an investor or a trader gain the longer-term perspective. Maybe provide some sanity from the day-to-day distraction of market volatility, if that's not the preferred time frame of a trader or investor's approach. But now I need to show you how to clean up the charts here. Let's switch this back to a 1-year chart. There we go, 1-year daily. We're still on the seasonality chart, so we're going to switch the style back to standard, and now we're back to familiar territory. But time has come for me to let you go, since we've checked all the boxes for what I wanted to do today. But as I do let you go, I want to make sure that you're aware of the full slate of educational resources available to you from Schwab Education, starting with these webcasts. So if you're here for the very first time, welcome. This is what I do on Wednesdays. I spend my time talking about how to use Thinkorswim. And if you'd like to see archives for previous discussions that we've had, you can check that out on our channel. So the very first thing that I would suggest you do is make sure that you're subscribed to the Trader Talks channel. Pop down below the video, click on the subscribe button. It only takes a second, doesn't cost anything to do that. But our Trader Talks channel on YouTube is where you can go to join the live streams. You can also find playlists of previous webcasts. So like if I go to playlists here, I'm going to scroll all the way down to the bottom. We have lots of different YouTube series. Mine happens to be right down at the very bottom, Getting Started with Thinkorswim. You can click on View Full Playlist. And you can find like last week's discussion or the week before that. There's the archive. Now, another thing Barb and I would suggest you do is to follow us on social media. We get the question all the time, how do we contact you guys when you're not hosting a webcast? Well, the answer to that is X and LinkedIn. So you can find Barb and me on X. You can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. I'm very active here. I just posted a video this morning about an interesting type of stock chart known as a Heikin Ashi candlestick chart. So you may want to check that out, just a 2-minute video there. But if you reply to one of my posts here on social media, I just try to reply right back to you, and it allows for that interaction when the camera's not on. Now, you can also follow me on LinkedIn. Just go to linkedin.com/in That's a typical prefix for finding a LinkedIn profile. And then mine is specifically /Cameron May CS. So linkedin.com/in/Cameron May CS. That'll take you right to my profile. Give me a follow there. I post on that platform as well. And if you reply to my post there, I just try to reply right back to you. So thanks for the follows on social media. I'll love to see you there. But quick reminder, there was a survey posted in this in the chat for the live attendees in this webcast audience. So if you're here in the live stream audience, click on that survey now. Time to fill that thing out. Two questions, and then a comments box and a suggestion box. I promise you, I will read the data. I read those comments. It gets sent right to me. All right. And finally, thank you to everybody for all the thumbs up. There were 100 and something number of people watching today, and it looks like 46 so far. I've clicked that like button there, that thumbs up on YouTube. Whether you're here live or you're watching on the archive, if you've enjoyed one of our webcasts, make sure to click that thumbs up button, because it's like a pat to the presenter, pat on the back for a job well done, but it also gives my videos a nice little boost in the YouTube algorithm, helps more people find these discussions so they can learn about tools or topics like gaining perspective over the longer term using tools, using chart tools on Thinkorswim. So thank you, everybody. Go enjoy the rest of our webcasts. Enjoy the rest of your day. I will see you again next week for another discussion of getting started with Thinkorswim. I'll also look for you in my other webcast series. I have something fresh every day of the week, as long as the markets are open. As long as I'm not on vacation, I have some webcasts going on. So I'll look for you in future webcasts. I'll also look for you on social media. But whenever I see you again, until that moment arrives, I wish you the very best of luck. Happy trading. Bye-bye.